Hey guys, you're listening to the Tasha Labs podcast. It's been a very intense week in the market, both for the crypto and for the TradFi markets. And I'm sure you are aware that Federal Reserve has hiked the interest rate by 75 basis points this week. That was the FOMC meeting on Wednesday. And prices have been down, of course. There has been a lot of drama going on. Including some of the largest lenders and market players, investment firms in the crypto market going under this week. I'm sure there are more to come. So it's been a lot of drama, a lot of intensity. So I hope you are at least cutting yourself some slack and having a relaxing weekend like I do. I'm sitting on my porch right now, enjoying some sunshine while I'm talking to you, right? So, I haven't put out a video for an episode for a while because I've been traveling, mostly in Asia. I stayed in Singapore for a little bit, and I actually held a party for like 200 people, in like Web3 investors and builders in the space. That was great fun. Met a lot of interesting and very smart people. One thing I noticed though is there was more investors than builders, and that was probably not limited to Singapore, in the Web3 crypto space right now. But I expect that to change as the bear market deepens, right? That ratio should go down. The investor to builder ratio should go down, which is a good thing for the space in the long term. But anyway, so what I want to talk about today is I'm not going to answer any specific questions, but rather I think I should give you an update on the market and on what I think is the outlook going forward, and also the what's the prospect for Web3 and crypto from my perspective, right, going forward. Of course, this is all my personal opinion. You take it or leave it. This is none of this is investment advice as usual. So again, the first thing that let's look at the market. What's been going on, right? So as you know, 75 basis point hike this week, and this is hardly the end of it, right? Fed already said in their July meeting they are expecting to hike another 50 or 75. That's not decided yet. Still they want to be flexible to respond to the economic situations going forward. Some people say that we are already in a recessionary scenario, but if you look at right now the thing is, if you look at the economic data, right, there's some mixed message there. So if you look at things like consumer sentiment, for example, it's already like very low, right? So if you look at the PMI, which is the manufacturing producer of manufacturing indicator, that also I think recently dropped below 50, which is like entering the recessionary territory, right? So, but on the other hand, you see that wage and employment growth is still pretty strong. But on the other hand, you can say that labor market is kind of a lagging indicator. But still, I think according to the current data, you can say broadly speaking, the U.S. economy is still in a decent place, right? So you may not agree with me if you go shopping in the grocery store and you see all the prices have soared so much, which I understand, right? But still, we are talking about after the huge stimulus of over the past 2 years of pandemic. The saving rate in the United States is at a it's at a pretty high level compared to historical average, right? So a lot of it you can argue is the money that the government airdropped to people's pocket, but nonetheless it's there. So saving rate is still pretty high, and the household balance sheet is still in a relatively good place. So so all the inflation will hit consumption, hit demand, yes. But still, we are not talking about, we're not in the worst spot yet at the current moment. So that's why I think the Fed says, from their perspective, the economy can take a lot more tightening than where we currently are. So you can agree with them, you can disagree with them, but that is their perspective for now, and that perspective is what matters for monetary policy going forward, right? So and right now they're saying they expect to tighten well into 2023. If you look at that projection for interest rates, it's not like lighten up. It will continue to increase in 2023. It's not lighten up until 2024, though these projections can change pretty quickly. But if you look at in terms of the hard data of monetary policy, so far you can see there is a shrinkage in liquidity. If you look at all indicators like money supply, M2, M0, the balance of reverse repos, all of them are indicating that money supply is off peak already, is on the decline, and liquidity available in the market is on the decline. If you look at the balance sheet of the Federal Reserve, the balance sheet peaked in, I think, somewhere in April 2022. Since then, it's been on decline. It's been either flat or on decline. Of course, these things they fluctuate, right? But the overall trend is they've been declining since April. And keep in mind that was when the Federal Reserve hadn't announced quantitative tightening yet. In April, they didn't announce, right? So now they officially they have officially started, at least they claim, it's official claim, started quantitative tightening, which means they're not going to renew lots of, some of the asset purchases, and potentially start selling assets. So nobody knows what the pace of that will be. They didn't say, but they only said that quantitative tightening will be significant. What does that mean? I don't know. Significant. How many trillion, how many billion is significant? I don't know, but that's what they say. Okay. So, but as you see, it's the message, at least both in the data and from the message from the Fed, you can see that it's taking a turn. I wouldn't say a turn, but like it's taken a direction that is way more hawkish compared to a few months ago, right? Okay, so this is where I want to look back and see some of my some of my expectations in the previous month, which I talked to you about in the previous episodes, about this year's market and monetary policy. I want to talk about my previous expectations and basically let's review some of the things that I got right and some of the things I got wrong. Okay, so so if you look back, I think I put out a episode maybe sometime in February. I forgot, but it was a few months ago. I talked about what I expect for this year, right? So basically, it's very simple. I expected a bear market because the change of where the wind blows in monetary policy. Okay, so I expected bear market, and I expected. At that time, I expected we will first see a lot of market volatilities tilted to the downside, but we will see significant downside volatility once the QT starts. So, and at that time, I expect the QT to start in the second half of 2022, right? So that was my expectation at the time. I thought the market would decline in 2022, but I thought the major decline will come in the second half of the year. At the time, the market already dropped, quite a bit, if we were talking about February. But at the time, I figured the extent of the market drop was actually higher than the macro condition, the financial conditions, or the tightness of financial conditions would have warranted. So at the time, I said I expected some sort of rebound because the drop was very fast. So we did got a rebound after the March FOMC meeting, if you remember, but that was a pretty quick and pretty short rebound. And I expected a bigger rebound than what happened, than what we got. But we didn't get a bigger rebound. So that was that. So basically we had a short rebound, but mostly it's downside volatility. And obviously, since the May CPI comes out, since the June FOMC meeting, we had a lot more price drop. Okay, so basically the bottom line is what I got right was this year market is going to drop. Okay, which is which at the time it looked pretty straightforward. But what I didn't expect was that it went so big, so fast, was pretty much very little rebound, or much less rebound than I had expected. Okay. So we had a little bit rebound, but it was short-lived. Okay. So that was that for the past few months. Where do we go from here? So if your portfolio has dropped a lot, I know many people's portfolios have done badly recently, right? So I all I can say is I'm sorry. I hope you at least manage your emotional state. Take care of your physical emotional state. That's the most important thing, right? So where do we go from here? So that's the main thing I want to talk to you about today, including in the short term and also in the long term. So right now we have the federal funds rate, which is like an interbank. It's like the America's interbank market rate at 1.5. Okay. It has jumped quite a bit since the 75 basis point hike this week. So but in any case, it's about 1.5 right now. And according to the Fed, what they think the rate should be is over 3.5. Okay, so we have like 2 percentage points to go. The direction is up compared to what the Fed currently says they're trying to target. And 3.5 or maybe even a little bit higher. That is like if you think they will increase rate by 0.5 or 0.75 each FOMC meeting, that would be another 3-4 times of hike to get to 3.5, right? So will they do these 3 or 4 times consecutively in every meeting going forward, or would they, space it out, let's say, another 75 in July, and then take a pause and see how the economy take it, and then, and devise their next step forward. I don't know. I think it would depend on the inflation print in the coming month, right? So, but overall, I think what is definitely true is we are in a micro environment that is going forward, that's going to have more and more tightening of financial conditions, and that direction I do not expect it to change soon. Now, the pace of how that tightening will go, that is a open question. And that pace may have some effect on the market. I will talk about this in a bit. Okay, but the thing is, I think pretty much you can expect another 0.5 or 0.75 in July FOMC meeting, and then according to the Federal Reserve, they're going to, since they've aggressively tightened for 2 months in a row, June, July. After that, they're going to reevaluate and see if they are going to do more in the short term. So but you can you can think about, I think I would think about this way, okay? The overall direction of the financial conditions is going to be continued tightening. Keep in mind, in addition to the monetary policy changes from the Fed, we also have ongoing, inflation, high print of inflation, which is in itself a tightening of financial conditions, because it is like, taking money out of it's literally like taking money out of your pocket, right? So you have to spend more money on the same amount of goods and services than before. That means you have less money to spend on other things. So that in itself is like a tightening of demand conditions that will, discourage demand from both companies and consumers. But anyway, let's say we have if we have a tightening schedule going forward that is less than the market expected. Let's say in July, instead of 75, they tightened by 50. I don't know. That could be a possibility. Depends on the inflation rate, report for June, right? So, and also because after July, the next meeting is in September. So if in September, the monetary policy change, the tightening, the magnitude of tightening is less than what the market expected. For example, if the Fed tightened in July and they say, okay, we're going to take a pause because it's been, we've been tightened pretty fast, and the market conditions, the financial conditions have been deteriorating pretty fast. If they say we're going to take a break, okay, and if that was not what the market expected, then we could see a rally, right? So I think it's all about the degree of actual realized at this point, right? Because we are already on the path of tightening. That's without question. But what makes a difference is the degree of financial condition tightening compared to what the market expects at that time. If it's less severe than the market expected, then we will very likely have a rally. But the thing is, that doesn't change any kind of overall direction, though. That's the thing. That's the tricky part, right? So, what do if you get a rally? Do you try to buy in and kind of try to scalp some gain out of it, or do you stay out? That is the thing. That is a choice that I don't have any advice on. That's your own personal choice. Okay, but it's a pretty difficult uh, situation, unless you're just a trader and that's all you do, day in and day out. If you're like kind of, medium to long term investor, and, given the situation, especially psychologically, a lot of people have lost a lot of money. So if you get a bear market rally, it would be very tempting to jump in and recoup some of your losses, right? But then it becomes very tricky, because I think overall it's still that kind of move is like you're still going against the market overall trend, because the overall trend is continual tightening. Okay. Even if short term you have some rallies because of instigated by the mismatch between the magnitude of market expectation of tightening and the actual magnitude of tightening. But it's like a kind of tricky to think about when you should get out in that situation, right? So I don't have the answer. That's a personal choice, but at least what I want to point out to you, my point is it's kind of a tricky situation, because it's very hard to time. In that kind of rally, it's very hard to time when you're supposed to get out, when the overall trend is still going down, right? So what do I expect the kind of capitulation, the so-called capitulation, or the directional change of monetary policy will happen? Again, it depends on how the inflation wind blows, right? So right now, you heard the Fed says they are very adamant in terms of capping inflation. Right now, what they're worried about is the wage inflation spiral up, right? Because once you have the tricky thing is, once you have higher inflation for a while, it kind of adjusts, like people's expectation needs to adjust. It will affect the negotiation of wages and salaries, right? And then people will go to their employer and say, look, inflation going up, wages have to increase, right? And then once you increase wages, it kind of goes in a cycle, connect to inflation, right? You inflation goes up, and then people's expectation changes, like expect higher inflation, and then the negotiated wages increase, and then that wages feeds into the cost of goods and services and propels another round of inflation, right? And then the next thing you have this you have a much higher equilibrium rate of inflation, because you have this loop of higher wages feeds into higher inflation, and higher inflation feeds into higher wages, right? So right now they're very worried about this kind of feedback mechanism kicking into gears. So they really want to clamp down the demand side in order to cool the economy. Of course, they won't say they won't come out and say out loud that we are going to push the economy into a recession, but I think very likely that's what they've got to do, because they really want to push the inflation not just down, but make sure the thing is dead. Okay, so they're gonna stomp on inflation and stomp on some more even after the thing is dead, just to make sure the thing is dead. Okay, so that's basically the intention. That's the intention they have right now. So my point is, what does that mean? That means the monetary policy is going to overshoot, very likely. I think it's going to be a situation that if they can have an effect on inflation, and that brings inflation down. And then they will continue maintain a tightened stance or even tighten even more, more than what's necessary. I think that's something very, very likely to happen. Not to mention that there is a huge component of this that they cannot, the monetary policy just cannot control, right? So one of the reasons that the tightening cycle has been going so, changing so fast in the first half of this year, and the market prices have been dropping like a stone so fast, is because we got really several shocks that we didn't see coming. I didn't see coming, right? So we got the Ukraine war, we got the China thing, right? China is still, Shanghai is still in lockdown, and there, new cases coming up. Who knows when this lockdown is going to end, and that pushes and tightens the supply chain even more. So basically, you have these extra shocks that people didn't expect at the beginning of the year, because towards the end of last year, inflation was actually coming down a little bit. So it was indeed sort of going in the direction of being transitory, like the Fed said, right? So, but then it went back up because, to a larger extent because of these extra shocks that we had this year. So, are we? So if so, you can looking forward. You can say that the food energy cost situation is not going to resolve itself anytime soon, because we still have a war going on, and that situation is not going to change very soon. And then we have a undersupply, underinvestment of energy sector issue. Though I'm not an energy expert, okay, I don't know how severe that situation is. According to some people, that's very severe. The underinvestment and undersupply of oil and gas sector. But everybody is talking from their own perspective, and they have their own portfolio, and that sometimes bias you towards one direction or another, right? It's not necessarily that people want to take a biased perspective, but it's just psychologically. I'm sure you experience this personally too, right? Once you take a stance, once you take a position in a portfolio, psychologically, you're more inclined to defend that position, whether it's valid or not. Like when I listen to a lot of energy bulls, a lot of them will, it's like downplaying the demand factor, because if you have energy prices, inflation going up so much, you're gonna destroy demand, right? So when demand comes down, theoretically that will bring that will put a downward pressure on prices as well. If you listen to the energy bulls, this is something that I wouldn't say they totally dismiss, but they don't take into account as much, right? So all these macro variables, they are the macro equilibrium is affected by so many factors, right? So if you kind of put a little bit more weight on one factor instead of another, you're gonna reach some different conclusions. So that's why you hear a lot of times you hear these macro commentators, one of them will tell you one thing, the other one will tell you something else. It's not that they do not see the point of the other parties. But it's a lot of times it's like people putting different weights into different factors, and that is unfortunately, a lot of times it's a very subjective judgment call. unfortunately, macro is not a exact science. But so that's why I'm telling you this is my perspective. But I'm not saying that I'm 100% right. As I said in the previous section, I told you a bunch of things in February what I expected, and some of them was right and some of them was wrong. Okay, the most wrong thing is I did not expect it will go down so fast and so to such a severe extent. Okay, and especially in crypto, right now we are in the face of triggering a bunch of liquidations and domino effect, forced sellings in the market, which is abundant these days, because I think at these prices, you don't have, unless you're like really really panicking, right? If you can manage, these are not. If you're like a long-term investor, in like any of the large cap tokens, the like we are not at a price level that you would voluntarily sell, right? So if you can manage, if this is like if you do not need the money, if you do not need the liquidity, why would an investor, after going through the previous cycles, right now the price is lower than the previous cycle high, right? Why would anybody, if they can manage, sell at this price? So, but a lot of selling is either you're panic selling or you are forced, you are being forced into liquidation because you took on leverage. So I don't see that situation. I don't see that situation, resolve anytime soon in terms of the general direction of macro. So basically, the bottom line is I'm not expecting the macro policy capitulation for the remainder of this year. We may get more and more, recessionary signals, recessionary price, recessionary, data for like different indicators. But again, I think the Fed is going to trying to overshoot. So that's why I do not expect that general direction of macro policy of monetary policy to change for at least the remainder of this year, and may well be the next 12 months, I think. So yeah, and eventually, if the energy and food situation does not resolve, if they like the Fed is managed to bring demand down, but they can only do so much. Demand side can only do so much, right? So if the energy and food prices remain elevated and they cannot resolve that, the last resort will be they eventually raise the inflation target from 2% to something like 3%. I don't know. But that's like eventually, that's like last resort, right? And that's definitely not going to be soon, definitely not going to be this year. Okay. So, but they kind of already opened the door to monetary policy not being entirely effective. Of course, it's not entirely effective, but they have come out and said it. The Fed, if you listen to the press conference of Powell, he said, inflation is not totally within the Fed control because the Fed cannot control the energy cost, cannot control the food cost, and those are big items in the headline inflation, and the inflation target is on the headline, not on the core inflation. Okay, so he's already said it. The implication is there is so much we can do. Okay, so if there comes a day that they have done whatever they can, but still inflation remains higher than the 2% target, what can they do? Well, at that point you can say, okay, this extra part is not within our control. Therefore the right thing to do is to increase the target, because we realize given the supply conditions of energy and food, we may need a different, it may imply a different inflation equilibrium. So, but that, I think we still have a long way to go before things come down to that. Okay, so I'm not expecting capitulation for the rest of 2022. That's the bottom line. So where does crypto go from here? So the other day I posted something on Twitter comparing the current market cap of crypto to like a current trajectory of price movement to the 2000 dot-com bubble burst. Okay, so if you think the two scenarios are comparable, which I think is, I think it, you can argue, okay, people also said the 2017-2018 cycle was the dot-com bubble burst for crypto, but I think that previous wave was too small. Crypto didn't have as much adoption at the time, and the total the total adoption user base is much smaller than what we have now. I think right now, if you look at the data, I think about 500 million, users, give or take 150 million maybe, of crypto products. It's a much closer to the kind of adoption, internet adoption around the time of .com, compared to the previous crypto cycle. Okay, so, and also the previous .com bubble burst was also triggered by monetary tightening, and actually it was not, but the tightening was not as aggressive. I don't think it was as aggressive as what we are having now. Okay, but in any case, I think we are, that's why I think the two scenarios is kind of comparable. But you may argue there's a lot more leverage in the crypto market now compared to the 2000 in the stock market, in NASDAQ. But let's just say if we compare the two, right? If you compare the magnitude of price drop of crypto to .com in 2000, then we have another 50% drop. I'm talking about the total crypto market cap, okay? So we have about, the market cap right now is about $900 billion. So if we assume the similar magnitude of price drop to the 2000 .com bubble burst, then that implies the total market cap will need to drop another 50% to reach the level of .com burst. Okay, I'm not saying that's what's gonna happen. I'm just saying, if you compare these two that I think are quite similar scenarios, that's what you get, like another 50% of drop in crypto market cap. So what does that mean for the price level? So if you look at obviously the biggest token is Bitcoin and Ethereum, right? That's like a huge chunk of the market right now. Bitcoin dominance is about 40%. Oh no, 45%. So it's like Bitcoin is about 45% of total market cap of crypto, and the rest are other tokens, right? Which much smaller market cap, potentially can drop a lot more. So you could have so to achieve 50% drop in total crypto market cap, it would mean it could be that Bitcoin needs to drop another 40%, and the rest of the tokens, non-Bitcoin tokens, drop another 60%. That could be a scenario, okay? Or you could have Bitcoin drop 30% and the rest of the tokens collectively, obviously some will drop more than others, but the rest, non-Bitcoin, drop collectively 70% in value. I'm just saying these are different combinations. Of course, a variety of combinations in between, right? that could get you a 50% of drop in total market cap of crypto. So and a lot of tokens are not going to survive because because of something that I want to talk about in a sec. Okay, but we are kind of running out of time. But the next thing I want to talk about is the long-term prospect of crypto and Web3 space, because you're seeing a lot of people. Obviously, right now market dropped so much, and people who are against crypto are very happy. They're like, I told you so, right? I told you the thing is all a scam. The thing is not gonna last. It's all speculation and blah blah blah, and so on and so forth. So my view about this is that those people, they are right in a lot of respect, okay? Because there is indeed a lot of speculation, a lot of fluff, and including a lot of scams, a lot of opportunistic behaviors going on in the Web3 space. And the reason being, we have tokenization, and which is like an ideal low-cost instrument for financial speculations. Okay, but tokenization is also the superpower of Web3, because obviously people use the term Web3 very liberally, right? If you actually go ask people, what does Web3 mean to you? I think you will if you ask different people, they will give you different answers depending on their personal background, and which will influence their perspectives, right? So it will mean different things to different people. So when I think about this, to me, from my point of view, the reason I am bullish about Web3, about the so-called Web3, I'll tell you what this means to me, okay? Web3, what it means to me is the tokenization of everything, period. So it may or may not involve decentralized blockchain. It may or may not involve decentralized governance structure like in so-called DAOs, which to a large extent does not make sense to me. A lot of these governance mechanisms, which is I don't think you can govern by just having people vote on things. At least not for majority of the production activities, or for the majority of companies and co-ops, or nonprofit or government organizations in the world, it's very, very difficult to actually govern anything, make any decision by mass voting. The cost is enormous, and the level of decision making is I just don't think that's going to be a very quality decision making process. But this is not about that. We can go into that in another episode in terms of who's taking the risk in the decision making, who's taking the responsibility in the decision making, and taking the the power of execution, and why does that not fit into kind of the DAO model. But that's for another day. But right now, let's just say, to me, the biggest selling point, the superpower of Web3 is tokenization. And the fact that what does that mean is that it makes it the blockchain, the public blockchains, because it's permissionless to access, right? And it's also a worldwide network. It makes it so easy to create some kind of like a tokenization system and to exchange one token system with another system using the same unified standard. So if I have a, if I have a token for my company, for Sunwise, I can have a community token for Sunwise that can exchange for some other for some airlines tokens on the secondary market, and because they're all on the same unified standard and there is a worldwide market for that, that is very, very powerful. So to me, I actually wrote about this, last week in the article that I put out on my website. I'll link to the article in the description. Okay. So basically what I said is one of the superpower of tokenization is it gives any kind of latent values in society a explicit expression. And not only that, make that value liquid, give that expression liquidity, and allow it to be exchanged with other things of value, just like in other in other any market system. So a lot of things that you can think of that in your daily life that has value but has no expression or a market price, because it's very hard to track them, very hard to express those values in some kind of database or in some kind of representation that will allow you to trade those values for other things. So if you cannot trade, then you do not have an expression of value, right? So it's very hard. So of course, tokenization is not a new thing. You have, if you go to like Costco, Walmart, if you're a long-term customer, you earn points. It's like your, essentially it's loyalty discount, right? You go to an airline, they give you points to airline miles to encourage you to be loyal to the airline. So you have these pockets in society, in like closed-end systems that already have tokens. Okay, what is token? It's just a database. Okay, it's a database of registering value. Right. So so you already have these. So tokenization is not a new thing. What is new here is you now have the possibility of a unified standard for all the tokens, and then you have a market that is worldwide, that has no borders and no walls, and that is very, very powerful. So and a lot of things can take advantage of that. I think if the potential of that unified tokenization standard, unified market, and very cheap cost of creating kind of tokenization system, if that potential, which is I think is the Web3's potential economically, if that potential is realized, that's gonna create another layer of GDP because you give another layer of, because you give hidden values, latent values in society, explicit expressions, and you're going to encourage the production of those values because of the liquidity and and the tokenization that created out of it. So that is going to create new industries, new GDPs, and new professions, and allow people to have more stream of income sources. And that is going to also have large implications in terms of income distributions, especially capital income distributions in society. All right, some of those I have talked about before. But really, to me, that is the immense potential of Web3. And to me, that is that's what differentiates Web3, quote unquote, if that's the popular term that we have now. That's what differentiates Web3 from, ultimately from what we had before, which is just the internet as we know it today. Okay, so some other people they may say, okay, they think the Web3 means like a decentralized production of resources, so on and so forth, or decentralized decision making. I don't see it. I don't see that as a defining characteristic of a new generation of internet. Because that to me is just a extension of Web 2, because you already, if you look at the successful applications of Web 2 era, there's already a lot of decentralization going on. You're talking about decentralization of resources. If you rent a house, if you rent a place to stay on Airbnb, that's already decentralized the real estate resources, right? That created the market for decentralized real estate. That's already decentralization. Uber, it already decentralized the automobile vehicle, resources to a larger extent. And so all these marketplaces, like social media, decentralized the content creation, right? Decentralized the media. So depends on how your perspective. To me, I think those are already decentralization, right? And you're talking about a blockchain, okay, decentralized database. Now databases is hosted by, a network computers around the world. To me, that's just an extension of what we already have on the internet. Okay, so it's like push it one more step further. So what? So to me, that's not a defining characteristic of this new era. The new era, what I think is new and groundbreaking, is tokenization. Is the kind of tokenization that has unified standard and unified worldwide market. That is going to mobilize a lot of values. Okay, but that's my perspective. Okay, so but on the other hand, because of tokenization, you also create so much more opportunities for financial speculation, right? That's the whole thing about all the hypes in crypto market. All this like cycles and boom and bust are going up like 500% and drop another 90%. It's like if you don't have tokenization, you will not have this kind of problem, or the kind of frenzy, right? Or the kind of opportunism, and the kind of like the extent of like scams and frauds that's going on in crypto. So that's the side effect of tokenization, is you financialize so many things, then you create like a much heightened market volatility than the actual innovation on the ground would warrant. Okay, so that is the downside. The other downside is that goes back to, we're talking about like most of the tokens, a lot of the tokens, they're going to zero, right? Why? Because there is not a product behind. So I talked about this in my last article as well. So I think you look at 95% of crypto products today. It's really there is not much of an underlying creation of value, aside from the fact that it has a token, and that token is driving a lot of pseudo adoption that is not going to stick, that is only there because price goes up. But the product in itself does not create much economic value. Okay, so if you take that token away, so I think a test of this would be, if you take the token away, does that product still have any value? Would anybody still use it, and use it for what? And if you look at that from that perspective, and you look at, okay, does most of the play to earn games have any value? Axie Infinity, if you take the token away, how many people will play Axie? It's not in terms of just the quality of game, right? So and also countless other examples in crypto. So my point here is tokenization. It kind of gives this because it's a business model that is so powerful. And the so-called a lot of like current day Web3 businesses, Web3 projects, because of this pair of crutches, right? Because these crutches are so good, the tokenization crutch, it hides the fact that the product itself cannot stand on itself. Okay, so then, when you have a market downturn, when the central bank changes changes direction, that crutch is no longer there, then the whole thing collapses. So and also, when the crutch is there, it hides the fact that the person actually can't walk, right? So because you're relying on a wheelchair or a pair of crutches to actually move you forward, right? For a minute it looks like, okay, this crutch is like tokenization. So for a minute, in the bull market, it looks like you're walking just fine, but once you take that instrument away, it's like you realize, okay, this person just collapsed. They obviously have not learned how to walk. Okay, so that's the downside of introducing tokenization. Even though it's very, very powerful economic model, but once you introduce that to a product that has not actually gained its, have not earned its market share, have not earned its place in the market, then it hides the fact that this is actually a non-product, right? So it's actually not a good thing for product development from that perspective, because it gives you the wrong signal. It mistakenly tells you, oh, look, I have so many users now, I have a lot of adoption to the product, but it hides the fact that those are not real, and it gives you the wrong signal in terms of, what direction you should develop the product. So to me, I'm mega bullish about the tokenization model of Web3. I'm just not. I'm just like not not mega bullish about the current application layer of the Web3 economy, and I don't think a lot of it is gonna stick. Okay, so. But I think if there are existing businesses and existing products and services that are already creating a actual value in the marketplace, and already having a product or services that has the market demand, then the tokenization can be a super powerful tool. And so I think that's the so what I'm saying is I expect the next wave of crypto, the so-called Web3 product, will integrate a lot more tightly with traditional products and services that actually has been tested in the market. Okay, and then you add tokenization on top, it's going to be it's going to be creating a rocket fuel. It will be a rocket fuel to the rocket that is already a rocket, but it cannot make a piece of it cannot make a rocket out of a piece of crap. So that's my perspective on the long term prospect. I don't think crypto is dead. I don't think Web3 is dead. I definitely see a lot of there will be new waves of innovation of Web3 products, but we tried a lot of things in this cycle. Most of them did not succeed, but there will be new things, new experiments, and new integrations, because this is a really, really powerful economic model. Okay, and blockchain allowed that to happen by creating this network that's worldwide, that has a unified standard, that is without borders. But would it end up be public blockchain? Would that be the global database that has universal standards? I don't know. I don't know if the infrastructure layer will continue, will stick for the next 20 years down the road. Because most of the infrastructure, blockchain infrastructure we have today, the layer 1, layer 2 of the world, they're not very performant. Okay. will we invent something else that has better performance, but also, share the same permissionless, feature, the open feature of the blockchain, global blockchain network that we have today? I don't know. It's a possibility. It could be that 20 years from now, what we call decentralized ledger or the blockchain platforms will be totally different compared to the concept that we have now. So, but anyway, we've clocked in an hour. It's going on a little bit long because I haven't pushed out an episode for a while. So apologize for running long, a little bit long on that. But final thing I want to remind everybody is that the biggest asset so no matter how much money or how lack of money you're in right now, I think the biggest asset in anybody's life, I think this applies to most people, okay, is yourself. Ultimately, that you are the best resource. You yourself is the gift that will keep on giving, okay? If you lost money in this cycle, what will make it back in the future? You. Even if your net worth is negative, even if your net worth is zero, as long as you have the capital, as long as you have the asset that is you always have an opportunity to make it back in the future. So really, and this is the asset that no monetary policy can take away from you, right? So I would really remind everybody, especially in the downturn, now that you don't have to check prices every day or every 5 minutes because it's just gonna be depressing, right? It's a great opportunity to actually take more time in investing in yourself, investing in new skills, investing in investing in knowledge to become a better investor, or if you're a trader, invest in skills to become a better trader. And if if the Web3 industry is a direction, it's like a career direction you want to go, then improve your tech skills, right? Improve your programming skills. Even as an investor, it will help you if you can actually code, right? If you actually at least can read code. So, oh my God, there's so many things to learn, right? If you want to improve the prospect of your investment returns in the future. Even just from that angle, from like a gaining more capital return in the future angle, I think that's the wisest thing to do, is to invest in yourself. Not to mention the labor income part, right? So, especially if you're, so I don't know like how old you are, but usually people who listen to my podcast, usually they are like between 25 and 45. Okay, that's like maybe like a 90% of my readers, I would say. So you still have a long life ahead of you, right? So like to me, personally, my goal is to live to 120 years old, which means, I really got to plan ahead because that, I will aspire to live to the day to see that robots be given human rights. So, but that also means, if I want to live to 120 years old, that means I have like at least two or three careers like ahead of me, right? So because I don't want to sit idle on the beach, even if I even if I have the resources to do that, I don't want to do that. Okay? Because that just does not sound like fun. So I will be looking at 2 or 3 careers ahead of me if my goal is to live to 120 years old, which I expect to be a lot of fun. But it also means that I need to like invest crazy in my own, human capital, right? So even if you don't aspire to live to 120, if you're like, I'm not, I don't think the human life is all that interesting. If I live to 70, 80, I'm done. That's way more than enough for me. That's fine. But still, that is a lot, okay? That is a long life. So you have a lot of days ahead of you. And I think if you want those days to be fulfilling, to be enjoyable, no matter what your net worth situation is right now, no matter what your bank account looks like right now, I think the best investment really is in your human capital, is in your mind and spirit and body, and that is ultimately the way to live a long and fulfilling life, regardless of the size of your bank account. Anyway, that is all for today. I will talk to you next time.